Nick Burmester, who's the head of hedge fund sales at MF Global Australia, and some of his Australian stock picks from October have gained over 60%, which outperforms the ASX 200 index, which has only gained 7% since then. All right, good to see you, Nick. Welcome back to the program. Let's talk about Australia at this point, because we do have the high-flying Aussie dollar. I guess people want to take it from a broader perspective, but where do you see the ASX 200 index at the end of this year? I know you love that question.
Yeah, it's always the golden question, Susan. We are pretty neutral at this point. In fact, we couldn't be more uncertain about whether to be long or short. We think that, you know, the commodity space in particular, which makes up most of our index in terms of its proportion versus any other index, we think they're due for a bit of a pullback. Those prices are very high, driven by demand out of China, which is slowing. And any sort of pullback could really see some of those miners bring our index lower. You know, and the banks and so on have recovered to probably mid-cycle valuation levels. So it's hard to see a lot of upside, particularly when you've got the US and Europe, recovering, but in a very patchy manner. So I don't think it's going to move much at all above current levels on a 12-month view.
Yeah, I find that very interesting how you were talking about the weakness possibly in the miners, especially iron ore miners. In fact, you're looking at more towards agriculture to go long in. Maybe you can explain why you want to short iron ore producers right now.
Sure. Our analyst in Sydney, Andrew Gardner, has done an analysis on where the benchmark iron ore settlements generally come in at versus where the spot price is. And right now you've got spot prices called $120 a tonne. That's 100% premium on last year. Now, if you do an analysis since 2004, or when China started really going, basically there's a 37% delta applied to where it'll settle. So that means that if we're 100% above last year now, in terms of the current spot versus last year's benchmark, you times that by 37%, that implies that this year's benchmark should be up by 37%, which is 0.37 times 100. So analysts actually want a lot more than that. So we don't think.
Okay, let's not get too technical
that,
here, Nick. You're putting our viewers to sleep. Nick, let's talk about BHP's cloppers here, because you're talking about these short-term contracts with the spot price. Now, BHP's Marius Kloppers, the CEO at the company, seems to be winning the war these days to getting spot pricing for iron ore. I mean, isn't that sort of a bonus for iron ore producers in the commodity space?
Yeah, it's a bonus when the spot price is high, but if things slow down and that spot price comes off, and you're an iron ore guy who hasn't locked in a full benchmark contract, you could be worse off in 6 months, 12 months' time. So that's the other thing. This is going to take a long time to pan out, and the market's waiting for anywhere from 70 to 100% increase in benchmark on last year, and we think that history shows they'll be disappointed, and you mightn't get an outcome all on benchmark. You might get more spot or quarterly sales, which if the world slows down is going to be worse.